Understanding Loss Given Default, LGD. A comprehensive overview. Loss given default, LGD, is a crucial concept in the realm of finance, particularly for banks and financial institutions that issue loans. It quantifies the estimated financial loss a lender incurs when a borrower fails to meet their loan obligations. This measurement enables lenders to make informed risk management decisions and is an integral component of financial risk assessments. Key features of Loss Given Default, LGD. What is LGD? LGD is expressed as a percentage representing the proportion of the lender's total exposure at the time of default that is potentially unrecoverable. This figure is essential for financial institutions as it aids in projecting expected losses due to defaults on loans. For example, if a bank has an exposure of $1 million at default and expects to recover $300,000 through debt collection or asset liquidation, the LGD would be 70%, calculated as $1 million to $300,000, $1 million. Importance of LGD. LGD is a critical metric for financial institutions for several reasons. 1. Risk assessment. It helps determine the risk associated with lending to particular borrowers and informs the credit approval process. 2. Capital adequacy. It is a key component in calculating the bank's capital requirements under Basel II and Basel III regulations, which govern banking stability. 3. Loan pricing. Banks can use LGD to adjust interest rates or terms offered to borrowers based on the perceived risk level. The relationship between LGD, probability of default, PD, and exposure at default, EAD. LGD plays a significant role in the overall risk modeling used by banks. The expected loss on a loan can be calculated using the formula \text, expected loss, equals LGD times PD times EAD \. Probability of default, PD. This represents the likelihood that a borrower will default on their loan. Exposure at default, EAD. This is the total value of the loan outstanding at the time of default. Together, these three metrics provide a comprehensive picture of the potential risk and expected losses associated with lending. How to calculate LGD? Understanding LGD calculation involves various methodologies. 1. Using exposure at risk and recovery rate. Backslash text, LGD, in dollars, equals EAD times, 1, text, recovery rate. 2. Comparing potential sale proceeds to outstanding debt. Backslash text, LGD, as percentage, equals 1, left, frac, text, potential sale proceeds, text, outstanding debt, right. The first formula is generally preferred for its more conservative estimate of potential loss, as it bleakly reflects maximum possible financial exposure. Factors influencing LGD calculation. Several factors can affect LGD. Type of collateral. Secured loans typically have a lower LGD due to underlying assets that can be seized upon default. Market conditions. Economic downturns can depress asset sale prices, increasing potential losses. Legal considerations. The efficiency of the foreclosure or recovery process can significantly impact LGD. LGD versus EAD, key differences. While LGD focuses on the anticipated losses following a default, EAD specifies the value of the loan at the time of the default. Here are the main distinctions. LGD indicates potential losses after considering recoveries. EAD signifies the total exposure without considering outstanding recoveries. By relying on both metrics, lenders can better manage risk and potential financial repercussions. Example of loss given default, LGD. To illustrate LGD, consider a borrower who takes out a $400,000 loan for a condo. After several payments, the remaining balance is $300,000. If the bank estimates an 80% risk of default, resulting in a 20% recovery rate, and expects to sell the condo for $200,000 upon foreclosure, the following calculations can be made. LGD in dollars. Backslash text LGD in dollars equals 300,000 times 1 to 0.20 equals 240,000. LGD as percentage. Backslash text LGD as percentage equals 1 left frac 200,000 300,000 right equals 33.33 %. Thus, the lender reasonably anticipates losing 33.33% of the capital if the borrower defaults. Common questions about LGD. 1. What is the significance of a zero LGD? A zero LGD is theoretically possible if full recovery of the loan is expected. However, in practice, such scenarios are rare and typically occur with highly collateralized loans or strong financial conditions. 2. Can LGD be influenced by external factors? Yes, external economic conditions, lending policies, and borrower creditworthiness all significantly affect the calculation of LGD and its applications. 3. What is usage-given default? Usage-given default refers to the exposure at default and is often used interchangeably with EAD in financial contexts. Conclusion. Loss-given default, LGD, is an essential metric within the financial industry, allowing institutions to measure and mitigate the impacts of borrower defaults. Through its relationship with probability of default and exposure at default, it provides a framework for understanding credit risk and managing capital adequacy requirements. Understanding LGD is invaluable for financial professionals, enabling better decision-making and risk assessment in lending practices. This comprehensive understanding of LGD not only helps financial institutions minimize potential losses but also enhances the stability of the overall financial system.